Welcome to The Edge, your weekly dose of financial markets and the Nigerian economy. This week, we're unpacking the CBN's latest circular on cash withdrawal limits, Q3 GDP hitting 3.98% with non-oil sectors shining, and a buoyant stock market rally last week on the Nigerian stock market, rising bond yields as well as treasury bond yields. Would also be responding to one of our followers who asked us to discuss why Access Bank shares are lagging their peers despite bold expansions made by the company. Stick around as well for expert insights on the anticipation surrounding US FOMC potential rate cuts and its ripple effect on the Naira. So let's break this down. Joining me today, obviously, it's my friend Dipo Ajayi. Dipo Ajayi is a vice president and head of fixed income at Chapel Hill Durham. Dipo, how are you today?
Yeah, good day, Tony. Nice to be around today once again.
All right, great. So let's start from the CBN's latest circular. So on December 2nd, CBN issued a revised circular on cash-related matters. So it removed the cumulative deposit limits and fees for excess deposits while capping weekly withdrawal limits at 500,000 naira for individuals and 5 million naira for corporates. What do you make of this? Do you think there are recent benefits in the current macroeconomic environment with these changes?
Well, if you remember vividly, and one of the things that's actually putting pressure on inflation is the level of liquidity in circulation, the level of currency in circulation. And of course, we understand that there are two sides to inflationary pressure. There are the supply side and also the demand side. It's actually the demand side that falls under the purview of the Central Bank of Nigeria. And if you have seen in the past, Central Bank have done many things to actually rein in inflationary pressure. We've seen increase in monetary policy rates. We've seen aggressive increase in CRL. That is the cash reserve ratio as well. And so another thing the central bank now is trying to do also to actually rein in the wind is to actually encourage deposit of this excess cash that's actually sitting in circulation.
Yes.
There are other different ways to actually get this done. There are moral suasions, and I want to say it's more like moral suasion. Central banks is just trying to lure people to actually bring their funds into the banking system, because one of the deterrents over time is the charges that comes with actually deposit beyond certain amount, whether as corporate or as an individual. And so now with the removal of this, so it simply means that a lot of business owner that's been sitting heavily, sitting on heavy cash. Some of them even have some of this cash in their shops. So with this, now it means that there will be confidence that can actually take this fund back to the bank. So what the central bank is doing is opening the door into the banking system and locking the door outside. So what they are trying to do is they are encouraging people to bring the money in. So they are now putting a bit of restriction on you taking the money out from the back door. And that's why they actually made a 500,000 weekly allowance for individual,
yes,
and also like a 5 million for a corporate. So what it means is that imagine a corporate that has bring in maybe a total cash of 100 million. So it simply means that all you can actually take out in a week is 5 million naira. You understand what that also means? Of course, there are some exceptions where government parastatals and the like, some of them were actually exempted from this policy. But when you look at it all in all, what central bank is trying to achieve is to further help moderate inflationary pressure. Because when you actually remove the level of cash that is sitting in circulation, it will help to actually win. It will help the central bank and the fiscal policy guy to also win in that direction. And also another thing also is the cash management fee. Central bank have come to understand that the cost of managing cash is increasing on the part of the bank. So it means that you want to take money from the bank to central bank and all those things. It comes with huge cost. So central bank is looking at a way to actually moderate this cost, and that's one of the reasons why they are trying to open the door so that people can bring in the money. And henceforth, it simply means that they can now encourage church people to actually use more like online banking systems.
Yeah, I think you already touched on this cashless policy as especially as how it's going to impact on inflation. So I'm also looking at how this might impact the naira. So you have the inflation and FX volatility to also think about there. So how do you make up this policy, especially in terms of the interbank liquidity, informal sector cash demand, even the overall monetary aggregates going into Q1 of 2026 when this policy would take effect?
I think one of the things that the central bank has been trying to achieve is to actually ensure transparency across board. We've seen that happen in the FX side. We've seen them actually try to extend that into the fixed income market as well. And also another angle is to actually ensure that they actually bring that into the level of cash movement. Because when you're actually fighting insecurity as well, you also need to actually consider things like this. How does cash moves around? It's very, very sad that sometimes you see people displaying naira and in huge volume, and he called for concern. It simply means that if you travel abroad, go to other country, you barely can see the currency. Most people just you do transaction online and something like that. So what the central bank is trying to do is to also told this line. And before you can actually do that, of course, you must be able to bring the one sitting in the system back into the banking system, and that's what they are trying to do. And I think that in no way will not impact businesses negatively. We've seen most businesses now, even small businesses, the whole pay, the money point has been one of their get to go or accounts because these payment platform or a POS,
the POS
they've
machines.
been doing a very great job. So you don't necessarily need to actually wait minutes before the person gets confirmation of the fund that you have actually sent, and that's more like a winning for most of these businesses. And to a great extent, most businesses don't actually want to carry cash again. And what the central bank is just trying to do is that there's the ones that still believe that we need to trade with cash. There are some places you still get to, they want you to actually pay cash for actually buying anything from them. So the central bank is trying to actually discourage that. And how do you discourage that? You need to entice people to bring the money into the banking system. You can't continue to put those caveats on it or those restrictions in terms of charges and expect people to willingly or willfully bring the fund into the system. So the central bank on their part, they are trying to do that as well as to ensure that after this fund has come into the banking system, they can now come. I feel that there will be another layer, and the layer is to actually encourage people to actually do their business online. And doing business online, I feel that it will also increase the level of activities beyond when you actually use cash transaction. Sometimes imagine a client coming to actually do a transaction of 5 million. You need to sit down, count the money to be sure that the money is complete. There's even an incident of ensuring that the money they are actually original. But not compared to where the person just actually needs to actually transfer the money into your account, and within a split of a second, you already you have gotten the alert that concern that you already have the funds sitting in your account, and that means that one, you can actually use your time better than the way you are currently using it.
Yeah, that makes sense, people. What I was actually looking at is how this would improve or increase liquidity in the system. Don't forget that back in, was it 2022, in the run-up towards the general election, we're told that we had huge amount of funds just sitting outside of the banking system. So if we are able to encourage these funds to come into the banking system, I imagine that would increase the level of liquidity in the system, which is really what we want, and CBN can then be able to handle its macroeconomic functions effectively. And also, you mentioned how this would impact, how this could help at curbing insecurity. We have all issues about ransom payments and all that. If that's not going to be possible, if the funds are not available, hopefully that's going to help to address those challenges as well. So let's switch gears a bit, Deepo. It's been a very busy week in the fixed income markets. Recall that DMO oversold at the last auction, same for the Treasury auction, and yields push higher across the yield curve. Now, with DMO revising upward, its bond and Treasury issuance for the remainder of the year, it appears the government is under pressure. Is that what it appears to you, or am I getting it mixed up? Where do you see first? Where do you think government is under pressure, and where do you see yields closing in the near term?
Well, we have currently seen a posture that we don't see from the government in a long time. Because when you go by precedence towards the end of the year, the government is less aggressive. But this year sounds more like a different time. And when you look at what happened in Q3, you tend to want to believe that it will follow the same pattern until when we noticed in the month of November when the president of Nigeria went to the House for that increase or of borrowing so as to be able to fund the supplementary budgets. And I think that actually impacted the market negatively. And when you go by what the level of adjustment to the calendar, of course, it is mind-blowing. You look at what has happened on the bond side. We saw what happened at the last auction. Currently, yield in the fixed income space already tending towards 17%.
17%.
You look at this is an instrument that actually closed circa 16% about a week ago. So, and at that particular point in time, we also even felt that that's more like a good way to go. Of course, anyone that actually missed the auction can still go back to the market and take advantage of the elevated yield level. And don't also forget that before that auction, these instruments were trading at 15.3 levels.
They were trading sub 16 levels.
So we saw the level of jump of about 70 basis points that actually pushed this instrument 16%. And here we are now at 17%. And one of the things that actually drove us this far was the adjustment to the NTB calendar as well, where we noticed that the DMO have adjusted the NTB calendar by circa 1 trillion. And 1 trillion, Tony, is not a small money when you actually want to raise this in the market. So it simply means that you have to come to the market 2 times to actually issue this in the treasury bill space. And this part of the time where the prime market has actually factored, those periods where you feel that there will be maturity, but there are no reissuance. So the perception already is that, those periods are periods where people that are holding instruments will be able to sell because there will be maturity and there's no rollover on the part of the DMO. But what we have seen that the DMO has come back to the market to actually adjust the calendar, to actually put a fixed auction on those days. And what that has done to the market is that it has pushed the market further up, and we saw what happened at the last NTB auction where the 1-year paper actually printed at 17.5. I'm telling you, 17.5. This was rate that we saw at the beginning of the year, not anything in recent time. So and the perception of the market is that we'll likely see more desperation on part of these guys because towards the end of the year, they need to raise this money. They will have to take it one way or the other. But what we have seen is that on the part of the short dated, the DMO has maintained status quo on those ones. In 91 days, continue to print 1530. And also the 180 days prints 15.50. So what we have seen is that what they are trying to do is they've ensured that they limit or adjust rate to ensure that they are not taking beyond those levels, the historical marginal rates. You understand? So they are more like focusing on long data to actually be able to actually take more volume on the long data, and that's one of the reasons that they've been able that has been pushing yield up. So for us, we feel that by the end of the year, we'll still be trading around 17% because There's still more auctions to go for the remainder of the year. We still have bond auction. We still have close to about 3 NCB auction as well. So we feel that these are some of the things that will actually keep rates at this elevated level throughout the year. Because if I missed at this auction, I'd rather just wait for the next auction than go to secondary market to buy.
Yeah, Deepo, talk to me. Won't investors be smiling? I expect investors to be demanding higher rates at the auction. Or will liquidity conditions or maybe market positioning cap the extent to which investors can demand higher rates? I expect the market to be smiling.
Yeah, of course, the market is currently smiling because when you compare where you were before, at the time we are 16% on the NTB side.
Yeah.
And currently we are now at 17 now. I'm sure 17 now is close to circa 20% effective yield.
Yeah, that's a decent return.
That's a decent return to anybody. This is risk-free instrument. So it means that if you put 100 million into this thing, you have a 20 million return waiting for you at the end of a year. So it is a risk-free return in for any investor, and I think that it's a very good one for anyone that actually wants to take advantage of this. And just like what you said, would investor want to come to the market to actually ask for more? Of course, investors are always very greedy. They want more at any particular point in time. And we saw what happened at the last auction, 17 up. Of course, I won't be surprised if people are actually bidding at the next auction at 18%, thinking that, okay, maybe the DMO can actually push further to that level to actually borrow. And that is going to be premised on the desperation of the DMO to actually borrow.
I mean, I think investors are simply reacting to the aggressive auction allotments and the heavier supply calendar that the DMO just issued. But let's look at the saving bonds as well. I think the saving bonds, the FGN saving bond is also on offer. The 3-year instruments, I think the yield is about 13.84%. Is this a decent return against inflation, or how do you see it?
Well, for the retail hand investors, I don't think it's a bad investment. And don't forget that most of these investors, they are not savvy investors. They are just looking for where to actually push from. This is far better than putting your money in savings accounts because what it means is that you are going to get a return of around 14% for a 3 year. So, and what the DMO has done is to further encourage this bucket of investors to ensure that coupons are paid quarterly. So it means that rather than waiting to actually get return from or get rather than waiting to actually get whatever you are credited on your savings account, you can actually invest in this line of investment. And it's also more like the way it sounded, the savings bond. It means that it's a form of savings to some level of investor. Imagine someone that's trying to actually you are trying to actually save towards something rather than just having the money sitting idle. You can continue to buy savings bond, and these bonds are actually offered every month. So it means that imagine someone that's been buying savings bond in the last 1 year, and you're buying 100,000 worth every month. By now, you would have had level of investment would have been 1.2 million. But the level of return, because at the time, these savings bonds were yielding close to 20%, 19, 18.8 levels return. And so imagine you having like a 20% return, or maybe an average of like 19% return over the life of your investment. It won't be a bad investment. So for anyone to actually invest in that segment as well. And the major focus for the DMO is to also open the window for the retail end investor because they know that investing in the main bond platform is actually because of the level of funds you require. Imagine going for an auction, bond auction, you need about 50 million to actually be able to actually participate in the auction. But for the savings bonds, all you need is 5,000 naira. And you'll be able to participate in this auction. So I think it's not so bad a one for people investing because of the level of their investment understanding. However, when you look at where inflation is currently printing and you're actually comparing that to the level of return, you feel that it's more like a negative real return for such person. But when you consider that, and sometimes when you invest, sometimes what we look at most times is inflation expectation. And when you look at what inflation expectation, we all think that inflation will likely print below this 16 by next year. So it means that we'll likely see inflation around 13% next year.
Then
So inflation,
it's going to be a
so
positive return at the
exactly,
time.
because it's more like a long-term investment. So when you look at it from that perspective, it won't be a bad investment for anyone looking to actually put fund in that.
All right, let's switch gears a bit deeper. So during the week, Nigeria's latest GDP report came out, and it printed at 3.98 year on year, shining or leading that path. Sorry, leading that path was non-on sector. How do you read this report of our economic momentum in the last quarter? And do you consider this rate as suggesting that the economy is stabilizing, slowing, or just muddling through?
I think when you compare to where we were coming from in the last 24 months, we weren't even talking around 3%. We were actually printing around 2% levels. And
Yes.
when you compare that to where we are currently now, and also when you look at year on year, Q3 last year, we printed 3.86. And currently
Yes.
we have done about 3.98. And when you look at it from that perspective, it looks good. But when you look at what happened in Q3 and in comparison with what we actually did in Q2, of course, it
Q2,
looks as if
it came down lower.
we slowed down.
Yes.
But when you look at it overall, it looks as if we are on the right path. And don't forget, some of these policies they have lagging effect on the economy. Sometimes you don't feel the impact just immediate. And I was discussing with someone that even the recapitalization of the banking sector will also feel that impact in our GDP, because you tend to actually see level of business activity to increase. Banks have more cash to actually play with. They have more cash to actually more like extend as loan. So it gives them headroom for them to be able to create more risk asset, and that in turn will actually increase the business activity in the economy. So when you look at it from that perspective, it looks as if we're on the right track. But I feel that we still have a longer way to a longer journey to actually cover.
Yeah, so let's talk more about the GDP figures. Let's look at the sectoral breakdown now. Which sectors tell the most important story? I mean, looking at the performance of the economy in the last quarter, and obviously that's going to give us an indication of where the Nigerian economy is heading.
So we see the information and communication sector doing excellently well. The level of growth is about 5.8, and the contribution to the economy is about 13%. So it gives you an idea of how that sector is actually growing. And we've seen a lot of development in that sector. We've seen a lot of new investment coming into that sector. The giant player in the sector like MTN, the Airtel, they are great players in that sector, and they continue to actually invest in that sector. And we continue to see the impact on the economy as well. Another one that actually comes to my mind is the financial sector. That actually printed around 19.6% level of growth. But that is not in isolation of the fact that the current, because of the new dynamics of computing our GDP, the finance and insurance sector now include the fintech guys. It also includes also the e-commerce guys as well. So it means that that's one of the reasons why we saw that level of increase. And the financial and insurance sector actually contribute about 11% to our GDP. But one thing that comes to mind, Tony, is that if we want to actually improve our GDP very fast, I think we need to concentrate on the agricultural sector.
I was going to talk about that as well, and also look at the fact that we're having negative growth in the manufacturing sector. Would this impact that Q4 projection of about 4%? Is that going to impact it because we're having negative growth in that sector?
So I think that firstly, I would touch on the agricultural sector, and the agricultural sector where you have a sector that contributes about 30% to your GDP.
Yeah.
And what it printed about 3.8. Of course, when you compare it to what we did last year, it seems as if we have done better compared to 2.6 that we actually did last year. But all in all, imagine your agricultural sector growing in double digits. You can
That's going
imagine
to
the
be
level of
significant.
the level of stuff that we can actually sell. And one of the constraints of this sector is insecurity, and farmers are not able to actually access their farm. And also, what is government doing in terms of actually educating farmers on better way to actually go about their businesses, and also the issue of seedling. Also, what is the quality of the seedlings that we're actually putting in place into the ground. Another thing also is about the storage capacity. What is
Mhm.
government doing, or how is government trying to encourage private institutions to actually come into that sector to come and invest? And I can imagine the level of opportunity that this sector actually brings to the table, and how it will actually affect our GDP positively. And
Yeah, Dipo, I mean, sorry to put in, while we're growing up, you see silos everywhere, grain silos, everywhere you travel across the length and breadth of the country. I don't see these silos anymore where we store grains, and during post-harvest seasons, if there's need for government to bring out grains from those silos, they do that. But I don't think we'll see more of that anymore. And obviously, that's as a consequence of the long or protracted insecurity issues in the country.
exactly. I think I agree with you on that because, and that's why it's very key that if you actually want to actually grow very, very fast and actually ensure that we start seeing the impact of the macro stories on the micro leg of the economy. Of course,
Yeah.
we need to actually fight this insecurity aggressively. You need to actually bring back confidence into people actually playing in that segment of the market.
Mm-hmm.
You need to be able to actually ensure that farmers can go to their farmland and go there and sleep. And I remember most of these farmers, most times, they have their farmland far from their village most times. So they
Yeah.
stay on their farmland. You understand? So imagine level of the way that bandits, terrorists are actually ravaging village. Talk less of farmland where you don't even have anybody
It's not
to actually
advisable. That's
protecting
just the
you.
truth of them.
You
It's not
understand?
advisable for anyone to go
So
stay in their farms anymore now.
so that is a big concern to the government, and also to the economy in that regard. And you mentioned about the manufacturing sector actually, which printed negative. I feel that we have, like I mentioned, we'll still see the lag effect of some of these policies that we have mentioned. The FX crisis is just disappearing, so a lot of people have actually lost confidence. I'm sure a lot of people
Yeah.
actually pretend huge losses. Imagine businesses like MTN for the year 2025 sorry, 2024 was printing heavy FX losses, and even to the extent that their financials their shareholders fund went into negative. And it's not only peculiar to MTN. We also saw that with Nestle as well. Their shareholders fund went into negative. And now talk less of that. Now talk about all the small businesses that are not able to actually cover some of this cost. So this has actually affected most of these businesses. But I feel that they are now coming back to life now. We are beginning to see more like a stable currency. At least in the year 2025, we can boast to say that we saw a stable naira
Currency.
in a
Yeah.
long time. And
Yeah.
also, naira sounds like you can now predict the currency to the direction at which the currency is going. The central bank governor last week actually came out to actually mention to us our net reserve. And when remember where we're coming from at a net reserve of $3 billion. Currently, we are at $29 billion net reserve, and that sounds great. It sounds
Yeah,
and
that's significant, and hopefully that helps with planning. Hopefully that helps the manufacturing sector to be able to find their food and contribute their quota to the economy. So
yeah.
Deepa would move on. So earlier in the week, we did receive a question from one of our followers asking us to discuss why Access Bank shares continue to lag its peers. So if you're watching this, you can always send us questions and you receive expert review and expert answers to your questions. Again, if you're watching, please like this video, share, and consider subscribing to the channel. So Deepo, let's talk about Access Bank shares. So Access Bank shares closed, I think 21.50 kobo last week. The shares have underperformed its peers in 2025. Its margins have fallen significantly to about maybe 25% from about 36%. So what do you make of this current situation with Access Bank? Because you've seen its peers like GT, Zenith. You've seen where the stocks trade. Is this as a result of the expansion costs that the company had? Because the company is expanding, I think, to about 15 countries across Africa. Is this due to the expansion cost, or there are other issues?
Well, I think I will start the Access story from the year 2024.
Okay.
In the year 2024, I was at a forum where the MD of the bank mentioned that the year 2025 will be a year of consolidation. So it simply means that they don't expect any acquisition in the year 2025. All they will do is to actually consolidate all the acquisitions and actually take advantage of that. You understand what will be the synergy effect of actually consolidating all these investments and into their books and see the impact. And that sounds more like a lovely story to the market. And at that particular point in time, we saw interest in Access Bank but along the line in the year, the central bank came out to talk about impairment that banks need to actually prepare for the forbearance, and Access Bank remain one of the top banks that actually is affected by this. So the market was waiting for what will be the figure. What are you going to print? How are you going to address this? Are you going to take it one off? Are you going to amortize over a period of time? And don't forget that central bank actually even gave a deadline to some of these banks. And so by H1, a lot of people were waiting to actually see the result of Access Bank to see how they actually will address this. And so, but what we noticed was when the result was actually after they actually audited their result, because Access Bank, Zenith, GT, some of these banks, even Fidelity, at H1 they actually present audited results to the market compared to other banks in that sector. So Access Bank, a lot of people were expecting, okay, what are they going to address this? They announced that they've submitted their result to central bank for approval, and also gave the market a full guidance of interim dividend, that they wish to actually pay interim dividend. And so they expect when they pay, so they expect central bank to actually just ratify the result. And so what we noticed was after like a month, Access Bank came back to the market to actually ask for further extension in releasing their results. And they moved that to the month of August. They moved it to the month of September. They moved it to the month of October again.
Obviously, this is what is amplifying investors' concerns about the stock.
Exactly. Yeah. So a lot of people were like, so what would have caused the back and forth between you and central bank? And that led to you further actually shifting the goalpost. And so at the end of the day, when the result, it was within this period that these other banks, their peers were actually enjoying the rally in the market. You understand? Yeah. It was at this time that Zenith was trading around 80 naira. GT went as high as north of 100 naira. So we even saw at a point in time, Wema Bank was trading better than Access Bank in the market. And then when you look at all these banks, Access Bank has a better valuation. When you look at Access Bank in terms of is heavily underpriced. You understand me? So when you look at their price to book ratio, it's about 0.2. And when you compare to like a Zenith that is around 0.4 or a GT that's very close to 0.6, you understand me? So it calls to question that why will people not be looking at Access that is heavily underpriced? But the concern still remains that the back and forth that they were having with the central bank. And at the end of the day, when they actually released their result, Of course, the market actually called it right. Because at that particular point, they were unable to actually pay interim dividends. And it's not because they don't have the fund to actually do that. But when the central bank look at their shareholders fund, there was a shortfall of about 40 billion that in their shareholders fund. That as a result, the central bank said that they are not qualified to actually reward their investor in H1. And also not even in H1. If by the end of the year that has not been resolved, that will still be there. It means that by the end of the year, investor will not be able to actually get dividend from Access Bank in that regard. So immediately this information came to the market, we saw another level of sell down. People that were actually holding this, believing that one day it go better. They couldn't hold any longer, so they had to go into the market and actually sell down some of their holdings in that name. And but we've seen a couple of action on the part of the management of Access Bank.
Yeah, I was going to ask you that. Are there operational issues or strategic changes that their management can take to rebuild confidence? Now, you mentioned that they have, good numbers, but they're trading below, they're trading below their fair value, but they have lower return on assets. P ratio is also below their peers. So what do you make of that?
Well, I think that Access, when you look at them, Access is a good name. The problem is that when you see their revenue, it's always very massive. But when you don't see their cost also is also very massive. So it means that their cost of their efficiency
is that cost related to those expansions?
So that is it. Sometimes there's a cost to every activity.
Yeah,
some of it comes as a cost to operational costs. You understand? You can't compare Access Bank to a GT Bank when you talk about efficiency. But to be realistic, Tony, Access Bank, they've done better this year compared to what we have seen in the past. You will see an asset that will have a top line of 4 trillion and they will have a cost of about 3 trillion. Almost like 75% of your revenue is your cost. And by the time you build other activity into it, you find out that you barely can actually scratch something out of your revenue as profit after tax. But what they've been able to do is that I'm sure they've been able to capitalize on their synergy. They've been able to find a way to use that to actually reduce the cost. And for me, I think that they're currently on the right path. And just like the question you actually asked in regards to what are they doing currently to actually survey the situation. Of course, the management are not currently sleeping. Currently, there's going to be, I think this week or last week, there's this emergency general meeting that they actually call, and also investors are also advised to also partake in that meeting, where they were talking about raising about 4 billion naira in form of private placements. And I think
4 billion or 40?
Sorry, 40 billion.
Okay.
In form of private placement. What they are trying to do is to use that to actually cushion the effect of the requirement by the central bank. So it means that when they have this fund, by year end 2025, they can actually pay dividends after the year end. And my good thing is that anyone that, if you don't have Access Bank in your portfolio, I think it won't be a bad idea for anyone to actually consider having Access Bank in your portfolio. And my view is just premised on the fact that by the year end, you expect Access Bank to actually pay full year dividend. And don't forget that they intend to actually pay interim dividend, which were stopped by the central bank. And also imagine that there's every likelihood that they will likely reward their investors with what will actually
come stuck with them over.
You understand? So with both the interim dividend and final dividend, so it will mean like it will be something that's a bit attractive when you compare it to their peers. I'm not talking in terms of absolute value. I'm talking in terms of relative value. Because imagine an Access Bank that pays declare a dividend of, let's say, a 3 naira dividend, a full year dividend for a stock that is trading 21 naira. That's about 15% effective yield. For a bank that is trading like 60 naira, for you to have that level of level of that level of return. You have to actually pay a dividend of about 9 naira. So, and you have to also look at it from that angle as well. So, for me, I think assets still very cheap for anyone looking to actually buy into the bank. It's a bank. If your horizon is a long time, don't forget that we talk about their investment in about 15 African countries.
15 African, yeah.
And don't also forget that the after activities as well to actually run off on a better ground in the year 2026. So it means that Access Bank will have presence across Africa. You can do business in any African country and also exchange and move money within because it's almost on around the same platform. So
yeah,
I
and
think
that's not
Access is a very good one.
That's not also including their presence outside of Africa. So yeah, there you have it. That's your response to your question about why Access Bank is lagging its peers. And obviously, you've seen that the bank has an investment potential. It's a bank that if you want to invest in, you definitely are going to be in for a good ride once the headwinds are cleared. So, Deepo, let's bring in closing. Let's quickly talk about the FOMC meeting that is coming up this week. So, market is already pricing in about 80 to 85% probability of a 25 basis point rate cut when FOMC meets December 9 to 10. What is your expectation? Do you expect them to cut rates, or do you expect FOMC to hold?
I think we'll likely see another 25 basis points rate cut, and yeah. We feel that that is much needed. There's been pressure on the committee member, and of course, the president already mentioned that in the year 2026, January, February, we'll likely see a new Fed chairman. Actually, imagine, and also when you look at some of those things, we'll likely see another round of 25 basis point rate cut. It may not be something as substantial, but when you look at it all in all, it will have a positive impact on the economy. It's an economy currently where we are trying to actually spur growth. You're trying to actually improve level of activity in the economy, try to actually create more employment opportunity. And when you need to do that, you need to actually tap out with your rate downward. And I think that is beyond the United States also. You also have impact globally.
Yeah, so talking about its global implication now, let's bring it to how it could impact the Nigerian economy. So let's assume the FOMC decides to cut rate further. Yes, it's going to reduce borrowing costs in the US, and we might see some potential flows bolstering Naira stability. But also, we might be risking imported inflation through maybe commodity channels and all that. So how do you see this playing out, and how do you see this impacting the bond market if the FOMC decides to go ahead with a rate cut in December?
Well, I think it's positive for Nigeria and other emerging markets economy. And my view is premised on the fact that even before now, we have actually seen aggressive impact in Nigerian Eurobond space. Just about a month ago, Nigeria was on the market to actually raise a 20-year instrument and 10-year instrument. And this instrument printed at 8.6 and 9.125. Currently, the 8.6 instrument is currently trading around 7.4 levels. And the 9.125 instrument currently trading around 8.2 levels. So it gives you an idea of how much investors are actually capitalizing on the elevated return on some of the emerging market names. And for Nigeria, I think Nigeria sounds more like on the right pedestal. We've seen in the year 2025, all the three rating agencies, they've rated us upward, and they've actually instilled confidence in the mind of investors around Nigeria. I mentioned earlier on that our net foreign reserve that is now at $29 billion. And what you mean by net, it means that there's no encumbrance on that value. It
And the
tells you
gross is
what.
about 46 billion. So
Yeah,
that's
yeah.
clear.
So it helps you to actually give confidence to investors, meaning that we have a buffer beyond, and a lot of investors that come to Nigeria and maybe at a point in time find it very difficult to actually move their fund outside the country. They are now having better confidence in the market. So beyond the even dollar-denominated instrument, we'll likely see the impact also in local naira instruments. Tony, if you're an investor and you expect naira to be stable for a period of 1 year, and you can see Omo instrument returning 25%. I would rather just buy an Omo bills, a 25% Omo bills, and wait over a period of 1 year. And if based on what we are even expecting, we expect naira to actually strengthen more against the dollar. So what it will mean is that you'll be winning on two sides in terms of return and also exchange gain. So it means that even as a foreign investor, you can actually be taking home close to about 25 to 30% level of return on your investment. Imagine those people that came into our market when the currency was at 1,600 and yield
even
was
about
at
1,800.
You understand? And yield was at 28%. And imagine what a level of return they've gained on the currency side. And when you add that to a 28% on the Omo bill return, it gives an idea of that most of them they're actually cashing out with not of 30%. And that is more like on a dollar denominated instrument for them, because by the time they come in and out, goes back to their currency. So I think that we'll likely see more of that actually play out because we'll see a lot of carry trade, people looking to actually borrow from a low interest environment and actually taking the money to high interest environment. And Nigeria is also one of it. And that's why I felt that maintaining rate by the monetary policy guys is also not so bad. You may actually feel you can look at it from.
We'll see some carry trade, and then we'll see funds moving in from the US market, hopefully, if Fed decides to cut rates. Therefore, it's been a wonderful time chatting again with you. So thank you, everyone, for watching, and Deepo, thank you for your insights.
Thank you very much for having me once again this week.
All right, everyone, thank you for watching. Please like the video, comments, send us any questions you might have, and we'll be back with another episode. Thank you, and bye.